So let's take this conversation forward with Nilesh Shah of Kotak AMC. Thanks, Nilesh. Great to have you on. Pleasure. Busy season, earnings, markets roaring, budget around the corner. So what do you make of things? And we know your view. You've been sort of asking investors to be a little cautious, but investors have a mind of their own, and this market has bought every dip up until now. How do you view the current market construct?
So there is a very great saying which says that markets can remain irrational more than you can remain solvent. So we have to respect market momentum. But when I was a kid in 1977, there was a movie called Amar Akbar Anthony. This market reminds me of Amar Akbar Anthony. Amar was an upright police officer. What is the quality stock? Reasonably valued stocks where there is high floating stock kind of signify. On the other hand, Anthony Bhai was Chalta Purja, naughty, mischievous, far more entertaining. There are many stocks which are in momentum, where floating stock is limited, where valuations are sky high. It's entertaining, undoubtedly. But we all know, in the end, Anthony Bhai has to converge to Amar and Akbar and become upright. I think it's time to buy Amar Bhai equivalent stocks. Try to slowly take profit from Anthony Bhai equivalent stock and wait till such time they join the bandwagon of Amar and Akbar.
Nilesh, you always have the best analogies. I mean, I don't know how you come up with them, whether you think it through or whether it's spontaneous, but it is literally the best. And it sort of explains the point so well. The issue right now is that, Amar Bhai has been sort of walking a very lonely path for a while now, and I'm talking about FMCG stocks or even banks for that matter, because a lot of people feel that Amar Bhai doesn't know how to run. So you have to leave Amar Bhai aside and think of maybe Akbar or Anthony. But to come back to the more serious point, I mean, IT has started delivering. We are seeing, first signs of perhaps a bottoming out over here. What about banks? What about FMCG? How much would you allocate to these in the portfolio now, given the market?
I think both these sectors have underperformed market for some time, and valuations are fairly attractive. We believe both these sectors have potential to outperform the market once momentum trade starts playing out. In FMCG, elections have given money in the pockets of consumers at the bottom end. Many of the state budgets are also putting more money in the pockets of consumers at bottom end. We believe budget will also provide boost to the consumption through investment in infrastructure as well as some direct benefit transfers. Monsoon is progressing on average monsoon, normal monsoon. Put all these things together, FMCG should start outperforming the market over medium term. Of course, within FMCG, you'll have to avoid those FMCG sector which is becoming like telecom sector, hyper competitive. Their profitability will go for a toss. You'll also have to look at those FMCG stock which is now catering to mass market products rather than just premium products. And most importantly, we are seeing unorganized sector bouncing back in FMCG with their innovative strategy. Who would have ever thought that a namkeen maker could command a very high valuation if gossips are to be believed? So innovation will be key, adoption will be key, but I think FMCG is one sector to bet upon over medium term.
We know our Amar Bhai for now. Nilesh Bhai, hi, good morning. Prashant this side. In two sessions today and Monday between now and the budget, right? That's the big going to be the big talking point, and we'll of course look forward to getting your insights once the budget is out. But right now, I think we can, for a short bit, talk about what the expectations really are, right? And from a capital market point of view, there is always this talk about capital gains and what will happen to capital gains. But there are also nuances. For example, for the mutual fund space, one big category which has taken in so much inflow has been arbitrage funds, and which have done very, very well. Some chatter amongst taxation experts that we could actually see some we could see some changes to that category as well. Arbitrage funds right now enjoy equity taxation, and there is some chatter that that may change? I mean, we don't know, but I just wanted to sort of touch upon that. Your thoughts, Nilesh bhai?
So Prashant bhai, many centuries ago, Kautilya mentioned that taxes should be collected like honeybees collect honey from the flower. I don't know whether Kautilya was aware of equity arbitrage fund or not, but definitely he hinted towards equity arbitrage fund. This fund gives investor perception that their income will be taxed at 15%, as majority of investors are in growth plan and keep money for less than 1 year. Arbitrage fund is classified as equity fund, and hence any earning of arbitrage fund in growth plan for less than 1 year is taxed at 15%. The government actually laughs all the way to the bank because arbitrage fund continues to roll over their future position every month, and in that they pay STT. The STT paid in last 3 years in Kotak Equity Arbitrage Fund between FY22 to FY24 is 1.1% to 1.56% of our average AUM. As a percentage of return declared in FY22 to FY24, it is 18% to 22% of return. And more importantly, arbitrage fund is only one trade in the market. If I am going short future, there is someone else who has to go long future. Otherwise, my trade will not go through. So the market participants, the long-only participants, pay another 18 to 20% of their return by way of STT. Collectively, 15% STCG from investor, 18 to 22% STT from the fund, and 18 to 22% STT from the market. The average tax collection for the government from equity arbitrage fund is 51% to 59%. Average of last 3 years is 56%. Where else this Kautilya's example of collecting taxes like honeybee collects honey is better illustrated. So my recommendation to Honorable Finance Minister will be, you should devise more ways of taxing like equity arbitrage fund, where you get more than maximum marginal rate of tax of 39%. And more importantly, investor is happily paying. There are also advantages of equity arbitrage fund. It provides financing to the long-only participants. And many a times, thanks to market efficiency, long participants are borrowing at rates which are very, very competitive. Without arbitrage fund, do you think retail investors would have bought 21,000 crore in cash market on budget? Probably no. So arbitrage fund is the perfect example of Kautilya's way of collecting taxes, and we should devise more instruments in that.
Okay, that's an interesting point. I don't think, at least I didn't think of it that way, but yeah, that's staggering STT collection for the government. It's a win-win, as they say, right? But you know, broadly on taxation, Nilesh, and I'm not getting into whether the 10% rate changes or not. From a mutual fund perspective, is there anything else that you would like to see? Because the debt blow was dealt about a year and a half back to the industry. Arbitrage is, hybrid is still a category where some funds still manage to get more efficient taxation. Any further tweaks that you would advocate?
So my only humble submission to Finance Ministry is that the tax incentive should be for the right opportunity. For example, Surbi, all of us would have put money into public provident fund account. Our parents taught us that from your first salary, please open PPF account. We did some calculation back of the envelope. If you had kept on putting 12,500 rupee every month for last 25 years, you would have put 37.5 lakh rupee in PPF account over last 25 years. PPF account interest is tax-free. The total value of that PPF balance from 37.5 lakh rupee would have become about 1.07 crore tax-free. On the other hand, if you had done same investment in SIP of an average equity-linked savings scheme, I'm not talking about the best performing equity-linked savings scheme, just average. the value would have become about 4.4 crore taxable. You remove taxation out, you still make 3 crore extra on 37.5 lakh rupee of investment between PPF versus ELSs. And markets have run up after I did that calculation. Now, where should our government give incentive? PPF is 15-year plus 5-year plus 5-year kind of investment. And we are giving incentive for long-term investment in fixed income. Shouldn't we be giving incentive for long-term investment in equity, which will create value for our citizens? How many Indians have 3 crore rupees as retirement package or as retirement kitty? Just one decision of choosing PPF over equity-linked savings scheme could have made that difference in 25 years. So my humble submission is there is lack of financial awareness among many Indians or most Indians. SEBI has done a fantastic work with mutual funds, sahi hai, but we have a long distance to cover. Our tax incentive should be for long-term investment, which makes India financially secure.
Okay, all right. I'm sure what you're saying is being heard.
The message is don't fix what ain't broken. So, I mean, just let it be more than anything else. Nilesh, by great conversation. Thank you very much. And I think those numbers put a lot of this, a lot of the arguments in clear contrast and perspective. So thank you for joining us. And as I said, we look forward to speaking with you once the budget is actually out. That is, of course, on Tuesday.